I know it can be challenging to go through a divorce or a separation, especially when there is a house is involved. There are three common scenarios that I have helped my clients in the mortgage business. Hello everyone, welcome to my channel. Recently, I received a question from a couple of the viewers on how to go about buying a house as a single mom or a single dad. I worked in the mortgage business in the past, and today I'm wearing my mortgage broker's hat to share the core actionable steps that you can take now in planning for your purchase of your new home. Also, I am staying current with the mortgage guidelines because I am a real estate investor. So mortgages are something that I understand and breathe on the daily basis because it's a primary financing source that I use to leverage where I see there is a fit for my new real estate projects. If this is your first time visiting my channel, please subscribe and turn on the notification bell. This channel is about investing in cash flow real estate, achieve your financial independence, and making an impact. My name is Korianne and I'm a real estate investor since 2001. I achieved my financial independence when I was 35 years old after consistently investing in cash flow properties over 8 years. I know it can be challenging to go through a divorce or a separation, especially when there is a house is involved. There are three common scenarios that I have helped my clients in the mortgage business. Scenario number one is one spouse decided to keep the house and buy another partner out of the home. Scenario number two is a couple agreed and decided to sell the house and split the property profit evenly and then get pre-approval for a new mortgage for their own new homes. Scenario number three is a couple went through a difficult divorce that led to the damaged credit scores. This is a longer case to get a loan pre-approval. A mortgage broker can guide and explain how and if your past home ownership may affect your current situation. What are the steps you can take now to plan for purchasing your home as an individual or as single parents? Many of the steps are similar for every borrower, whether it is the first-time home buyers, move-up buyers, single moms, single dads. These steps are applicable to you when you need a bank mortgage for your new home. Step one, organize your personal finance. Every lender and bank will require you to provide these documents. Number one is income. Your current monthly incomes and your last 2 years of tax returns. They want to see if you have an income to support the monthly mortgage payments. When you are with your partners, you may have two incomes to support the monthly mortgage payments. Now, as a single parent, the lender only look at your income. You can also gather your child support documents if you receive that. The lender will use this income on top of other income sources to qualify you for a mortgage. Number two thing is credit scores. Lender always pull your credit report to check on your credit worthiness and rating. They want to make sure that you will be on time to make the mortgage payment and other debt obligations that you have on your credit. You can pull your own credit to review to see if anything on your credit report does not belong to you, or if some credit debts balance belong to your ex-spouse. You can request your spouse to release these debts from your credit report so they will not show on your credit report. The more debt payments on your credit report, the less amount of mortgage you will qualify for. The monthly debt payments is adding to your debt to income ratio. Therefore, you want this debt payment to be removed. If you got bought out of the property from your ex that you had your name on that mortgage, make sure you have documents to show that your ex bought you out of the property and now the debt should not be in your name. The credit company would like to see this document for them to remove it from your credit report and your debt to income ratio calculation. Also, you want to check on any mistakes that show up on your reports not belonging to you. You can fix them directly with the credit bureaus. Human errors do occur, and it's not your fault. You just need to know how to spot them and request with proof to get them fixed and removed from your credit report. Keep your credit report as accurate, as clean as you can. I recommend pulling a free credit report from the Credit Karma. I use it and my family members use it to monitor our credit rating. You can lock your credit accounts so other creditors cannot pull your credit report without your permissions. You can protect your credit accounts with TransUnion and Equifax. They are free and you do not have to pay for these services. There are other credit monitoring companies out there that provide similar service, but for a fee. I used to pay about $10 per month for service before switching over to Credit Karma. I have used Credit Karma for a few years now. If the unfortunate scenarios happen to you that you did not have an amicable divorce, your credit may be damaged in the process. Review your credit carefully and plan to clean them up gradually. Gather all the supportive documents to support your request of the credit companies to fix and to remove these dents from your credit report. Your mortgage broker or loan officer can help you do this for a small fee, and some of them even do it for free. Number 3 is asset accounts. The lender wants to see how much you have for the down payment on your new home and a cash reserve for 3 to 6 months of the mortgage payment after you purchase your new home. You can gather at least 3 recent months of your assets from your investment and bank accounts. Keep in mind that retirement accounts are not accounted for a down payment, but they are accounted for the cash reserve to make your loan application better to the lenders. Number 4 thing is liability accounts. Once you pull your credit reports, you will know your monthly debt obligations. Knowing your monthly debt obligation is an important aspect to be a homeowner. The more monthly debt payments you have, the less mortgage amount you will qualify for. Checking on your liabilities will allow you to make a smart financial planning. For example, if you have a dream home requiring high monthly payment, then you know that you would have options to pay off some other debts so that you qualify for a larger amount of mortgage. One other thing, I highly recommend everyone to keep the housing debt to income ratio to be not more than 30% of your monthly income. For example, if your monthly income is about $10,000 per month, ideally you should plan for your mortgage payment to be around $3,000 or less per month. It's the smarter financial decisions because you want to be a homeowner for a long time and capture many other benefits that renters do not have without a lot of financial stress to keep up with the monthly debt. These are the critical data that you want to gather first before meeting with a mortgage broker or a loan agent. So after you gather all of your documents in step number 1, the next step number 2 is to discuss your option with a mortgage broker, bank loan agent, or credit loan agent from a regional credit union. A real estate agent typically does not know how much home you can afford or advise you on what mortgage option is best for you. This is where the mortgage broker or loan agent come in. You should consider reaching out to 3 different financing sources. Why 3? You would not know who is your best loan agent that can kindly guide you through this complicated loan process to understand all the loan options and earn your optimal choice given your specific circumstances. To find the best loan agent, start by asking for referrals from your friends and families. If you don't receive enough referrals, then start calling around and check on their review on Google or other review websites before making your appointments to see them in person. I realize the process of selecting and meeting 3 different financing sources will take up your time. But trust me, shopping around now will save you significant amount of money. By different financing sources, I am talking about a mortgage broker, a loan agent, or the direct lender like Wells Fargo, Chase, or Bank of America, and one loan agent from a local regional bank or credit union. You should meet them all and see which one will have your best interest at heart. Ask them to run through the few loan and mortgage options for you and see which one will meet your financial objectives. Let them explain to you each option so you will fully understand them along with the estimated closing cost. After you meet these 3 financing sources, you will understand where you stand with your loan options and qualifications for a new home purchase. Then you can decide on the timing of your purchase. A mortgage broker is the best source when you have some issue with your credit rating because most mortgage brokers have access to a broad set of loan programs, not limited to just one lender to meet each individual needs. Their closing costs will be higher compared to a direct lender or bank because they have administrative costs to run their business, but they can shop for the best mortgage rate for their client, and in turn, the client will save on the mortgage payments during the life of the mortgage loan. You as a consumer should shop and factor everything in to determine your net cost and the total benefits. A direct lender or credit union's agent tend to have a smaller set of loan options, especially their own products. They may have less than 10 loan products to offer you, but their rate is lower and their cost is also lower. They are a great source for borrowers with great credit, income, and assets. The cost of the loan process is your time and a small fee of your credit report, and some lenders may not charge you for it too. Going through a loan pre-approval process is the best way for you to know where you stand with your finance, and when you work with a knowledgeable loan agent or a mortgage broker, they can help guide you in the right directions. Also, you should always share your objectives with them and stay within your budget of affordability. You now have only one income to support the payment, so planning well to be a proud homeowner. So that's it for today. I really hope you enjoyed this video. Do not forget to subscribe to my channel and do hit the bell icon on your way out too, and also click the thumb up. Thank you to ones asking the question. I'm grateful to have you here with us. Please share this video with your client, friends, and family who may benefit from this video. Let me know in the comment below if you have additional questions or topics. I can help you further in the process of becoming a homeowner or a new real estate investor. Thank you so much for watching. Let's learn, invest, and make an impact. Ciao!